Okay, that's awesome. Well, good morning, and well, hopefully good morning, good afternoon, good evening, wherever you may be. Thank you very much for having me today. As Lou mentioned, this has been an incredibly exciting week for the Maker Dai project. On Monday, the 18th of November, Multi-Collateral Dai was launched in the most decentralized manner possible by a random community member named Andrew Redden. So the first thing I would like to do is express a great big thank you and a lot of gratitude to Mr. Redden. So now what I'd like to do is just spend the next couple of minutes outlining the expected impacts of launching Multi-Collateral Dai, or what I'm just going to refer to as MCD. It sort of bears mentioning, even though it literally is in the name of MCD, but MCD means more collateral types. And that quite literally is any collateral type that can take the form of an ERC20 token, may be voted in by governance and used as a new type. So what's happened is Maker governance, and obviously those are the folks that hold MKR and vote, they chose to start with ETH and BAT. And it's not that they couldn't think of any other collateral type, but BAT was the first choice to showcase what MCD can do. And I really look forward to the sort of new collateral types that Maker governance comes with, votes in and comes with in the future. So, what does it mean that the protocol can use multiple collateral types? So, at the core of MCD is the requirement to attract as many uncorrelated collateral types as possible. The more uncorrelated the collateral types, the more diversified the overall collateral portfolio is, resulting in lower risk and a lot more stability for the system and by default, the stable coin. But here's the issue. Currently, the available native crypto assets are far too correlated and also far too small to scale the system. So we need to look at transitioning real-world assets to the blockchain, and that's what's required. In the short to medium term, I would say that real-world assets that will be the main provision of the necessary diversification and volume. And the benefit of doing that is to induce the analog world to realize the massive value of operating on-chain. So it bears repeating, if you look at the use of tokenized real-world assets as collateral types, it is a way of transitioning, inducing the organizations in the analog world to see the value of operating on chain. And the reason I say that is because in the long term, I see business operations conducted on chain along with the issuance of securities of those businesses and even the underlying operations with respect to trading assets, with the trading assets and providing services with those businesses. So tokenizing real-world assets also includes a lot of reimagining of capital formation and structuring. Generally the idea of debt equity structure will give way to more granular claims on organizations creating a wider spectrum of capital choices. So new tokens, in my opinion, will start being created that lay claim to specific revenue flows that are in an organization, or even specific assets within the organization. And you're going to move away from just simply standing in line to lay claim on the remaining net assets of an organization. You're going to create this granular aspect, which is going to create opportunities for new asset types and therefore also new collateral types. So I think that tokens placed on chain with their associated business operations will release a liquidity premium from the transparency of being on chain, as well as price discovery from the multitude of available trading venues that these tokens will be able to access. I think if folks recall a famous Peruvian economist by the name of Hernando de Soto, and he speaks of debt capital being the blocker for all emerging economies. And even Hernando de Soto has started on-chain a tokenization to try and revive debt capital. But Maker, in terms of the protocol, takes it even one step further and provides the possibility for organizations to develop really alternative financing based on anything from tokenized invoices to tokenized capital that really was considered dead at one time. But multiple collateral types really is one, or just the first aspect to consider. The second is the Dai savings rate, or DSR. And this is really interesting as far as I'm concerned. This is the real attention getter. The Dai savings rate, or DSR, is really an amazing construction. It's simple to understand, very simple to use, but it has profound implications through its innovation. The DSR plays really an important part in balancing supply and demand of the protocol. If you think about it from a stablecoin point of view, arbitrage is the first layer balancing mechanism. Thereafter, the stability fee, and now the DSR becomes that second layer mechanism looking after the supply and demand respectively. In short, all the DSR is simply a smart contract where you transfer your Dai to, and that's it. But really, what makes it special? Well, when you transfer Dai into the DSR, you still own it. The Dai simply just sits in the DSR smart contract. The Dai does not get used by the system. There is no rehypothecation or further credit generation on the back of it. So consequently, the really interesting aspect about this is that there's simply no counterparty risk. The risk that you take on is the inherent risk of the decentralized protocol. So there's a reimagining or redefining of what risk-free really means. The payment that you receive for transferring Dai into the DSR smart contract is based on a trust-free basis, as it is the trustless protocol, to which you are exposed. So what I'd like to think about now is the DSR isn't so much a risk-free rate, it's a trust-free rate. So there's a little bit of an ideology stuck in there. So what this poses is really kind of an interesting question. If you stand back for a second and ask yourself this question, which would get the higher credit rating, a mega bank or a decentralized protocol? For me, that's kind of interesting because it really gets to the essence of what DeFi really means. The next thing I'd like to talk about is, with respect to all stable assets, inflation turns stable assets into depreciating assets, even the US dollar. And the DSR is really one of the first defenses against depreciation that does not come with a fee. So what do I mean by that? That there's no fees to using the DSR. Other than the gas to really get the Dai into the DSR, it's free. So it's free, it provides a stable store of value, and now you have the ability to include the next characteristic of a non-depreciating store of value. One thing that is really interesting as well is that the DSR is, just to reemphasize, simply a smart contract. And that can be integrated into any exchange, wallet, dApp, or organization. It is a composable base component for any on-chain application, and consequently may become the base rate for the DeFi space. But one thing I'd like to do before I move on to the next slide, I'd like to leave you with kind of a little bit of a nugget. What if Dai was generated from vaults already with the DSR attached? I mean, it's a really interesting point, and I think it's a conversation for another time, but I definitely would like to leave you with that little bit of a nugget. So what does this all mean? Multiple collateral types in the DSR already is what is new in the Maker protocol. 2 added features on top of an already proved out protocol. So what should we expect? I've spoken about multiple collateral types, and specifically how tokenized real world assets will help to scale the protocol to a massive value in supply that can cater for things like global payment systems all the way through to alternative financing. But it's really the fact that the Maker protocol is now the realization of a vision. And that vision is the protocol has the 2 financial tenets that are needed to create an economic engine. That is collateralization and credit generation. To the extent that the stablecoin produced is almost like a byproduct. So the protocol is an engine that helps facilitate the growth of an economy on chain. So as an example with DSR, the DSR could easily start with exchanges earning a return on their inventory that they've created, as well as market makers and trading desks parking their net sort of stablecoin value in the DSR. And then obviously beyond exchanges, we can start looking at money apps like Robinhood and Square. Obviously first on the crypto side of their business, but I would anticipate in the future that this would move over to the traditional side with the sort of the final expectation, the sort of futurism of really seeing the legacy institutions using this protocol in their architecture in the back end. So for example, with payments and points of sales, merchants could store payments in the DSR, take a cut or transfer it over to the consumer, making them more competitive. Charities from a philanthropic point of view can allow people to make refundable deposits and just keep the interest, use the interest to fund the charitable causes. So considering the amount of idle capital that is really sitting, not generating much, this is really a large opportunity for positive impact. And then the same concept can also be applied to, for instance, on the other side of the spectrum, gaming companies. They could invent totally new player behavior schemes, new ecosystems where the refundable deposit generates interest, and that accrued interest can be used to buy sort of in-game items. To that point, we have 400 partners that we're already working with to introduce MCD and DSR. But really the beauty of MCD and DSR is that it's going to have a profound effect at all levels, from the individual to the entrepreneur to businesses, and not just biased to any one group, and not biased by any one jurisdiction. And this is really important because from our point of view, that's why we think DAI will become the world's first unbiased global currency. And with that, I'd like to say thank you very much for listening and giving me the opportunity to join you today. So I'm open for questions, but also pass it back to you, Lou.
Okay. Thanks, Steven. That was great. And thanks for sticking around for the Q&A at the end. And with that, Allison, you want to take now Allison Lu, co-founder and CEO of UMA. Allison?
Great. Thanks everyone for having us. I'm super excited about the launch of MCD. Just as a little bit of background context about UMA for those of you who haven't heard about us, I'm one of the co-founders. What we're building is a decentralized financial contracts platform with the mission of enabling universal market access. I'm not going to go too deep about what our platform is, but suffice it to say, we're building two sets of infrastructure, a decentralized Oracle service, and basically smart contract templates that make it really easy to create decentralized financial products. Specifically how we work with DAI is that our contracts actually use DAI as our margin currency. So just to give a quick example, if you wanted exposure to, let's say gold, you could buy and sell a physical bar of gold, or you could just simply exchange an ERC20 token where this token's value is backed by some amount of DAI equivalent to the price of gold. And so obviously this whole migration from Psi to DAI is very important for us. And I'll be talking about 3 points, a huge win, a potential risk, and learnings throughout this migration. So I think the biggest win is really being able to add more collateral types into multi-collateral Dai really allows us to create a much calmer Dai. So one way to think about this is that any given currency really reflects an economy's underlying activity. And for single collateral Dai, that simply reflected the demand to borrow and lend against ETH. If you add more collateral types, though, in theory, that diversifies this economic activity, this borrowing and lending activity. And that should actually also result in more stable DAI prices, supply, and even stability fees. Such that if you have a much calmer DAI, using that MCD inside of a given smart contract as collateral should expose the user to less of the volatility of having only a single activity underlying its price and supply. And so to actually provide a real world example of this having played out in the past, the graph on this page basically looks at Colombian peso, which is an economy that is heavily dependent on oil exports. And you can see really closely how the price of the currency actually tracks the price of oil really closely. And you can see the same thing in single collateral Dai as well, where both the price, the stability fee, and the supply of single collateral Dai really closely reflected the price of ETH. And being able to now, instead of make it just dependent on a single price of ETH, instead dependent on an entire portfolio of many different collateral types, can really only be good for the stability of the product. That being said, though, there is a possible risk on the horizon, which is, what will the governance of maker holders actually be? And if we start accepting tokenized real-world assets as collateral in MCD, there's all these weird things, weird questions that might start to arise. So could on-chain liquidations get disputed in a real-world court? And can real-world laws actually end up being overridden by on-chain code? I don't know if we know the answers to that necessarily, but it kind of the governance burden on MKR holders and the risk of DeFi kind of battling it out with CeFi or centralized finance is going to be really interesting to watch. The final thing that I'm going to point out is an analogy from kind of the fiat world that I'm going to be paying really close attention to during the Psi to Dai migration, is the migration itself from the Psi token to the Dai token kind of analogizes loosely to a real world example of a futures calendar roll. Basically what this means is, in the fiat world, most people who buy and sell futures contracts don't actually want to take delivery. So if you buy like a gold futures contract, most people don't literally ship in their mailing address and accept bars of gold at delivery. Most people actually just roll it forward, meaning they sell the futures contract that expires soon and they buy the futures contract that expires later. Which is kind of like what's happening here, where people who own Psi are generally sort of migrating or selling Psi for Dai, and if they don't, they get delivered. They get delivered ETH at global settlement. In UMA's case, some of the financial infrastructure that we're building for the Ethereum community creates these expiring synthetic tokens, where we could create like a synthetic gold token, for example, that expires next month. And watching how this on-chain migration from Psi to Dai occurs in a decentralized, large-scale fashion is going to be really interesting for us to figure out what learnings we can apply from this migration to our own token migrations, with the general interest of promoting as much liquidity as possible in all of these synthetic products. In this real-world example here, you can kind of look at the open interest numbers in gold futures contracts, and you can see how aggressively the open interest will shift from one month to the next month as we approach delivery, because most users don't actually necessarily want to take delivery of the underlying collateral. I don't think it's ever been done in a large-scale decentralized way, the way that this Psi to Dai migration has. And so really kudos to the Maker team for being able to pull this off and to actually be able to pull this off in a decentralized fashion. And to be able to pull this off so quickly as well, all things considered, given that at least I think at least 10% of the supply has already rolled forward the last time that I checked. It's pretty amazing given that there were over 100,000 or nearly 200,000 Psi holders, that such a decentralized community has actually been able to commit to this migration so quickly. And it really speaks to the utility of Dai as a DeFi primitive. And we'll be watching closely as it continues to see what lessons all of DeFi can learn from this. That's it for me. Thanks, everyone.
Okay, terrific. Thanks a lot, Allison. Next, turn it over to Tim Ogilvie, COO of Stake. Tim?
Great. Thanks, Lou. All right. So, yes, this is Tim Ogilvie from Staked. And I thought, given that Steven's hit kind of a lot of the impact on MCD at a high level, one of the things that we would look at, because we think about yield all day long, is kind of the general yield environment, a little bit of a macro look at it, and what we think multi-collateral Dai means in that context. So by way of intro, who is Staked? We generally provide technology that gives crypto investors non-custodial ways to earn yield. And so what that means, we run staking nodes on 16 proof-of-stake networks, and we have smart contracts for ETH, DAI, and USDC, now Psi and USDC, that optimize yield on decentralized and trustless lending products. And so this, I think, is the money shot of where I think the DSR really gets exciting in today's world. There are $17 trillion in negative yielding bonds that are out there. And that means people are paying for the privilege of having someone take their money versus putting it into a productive asset. And that number is growing and doesn't seem to be changing anytime soon. And meanwhile, you've got this funky situation in US dollars and US dollar stablecoins, where the US dollar 10-year treasury is probably about a 1.5%. So you can borrow money at 1.5%. And with a stablecoin lending, you can turn around on a fully collateralized offering and get 5.2% in yield premium. And so this is the kind of thing, when you look at a finance textbook, shouldn't happen. You have effectively two products that have very similar characteristics, and they're a really big difference in terms of yield. So what's going on? Like, what are the problems here? I think number one problem is constrained capital. You do not have easy ways to get lots of money to take advantage of something like this, which in traditional FX would be called a carry trade. There are risks in the underlying collateral, right? You've got ETH, which is a volatile asset, and to the extent it underlies DAI, that's a little bit scary for people. And you've got some immaturity concerns in terms of smart contract risk. How do you get money in and out? And just this overhang that we deal with in the US around regulatory concerns. And so I think that multi-collateral Dai is going to help open those floodgates and really start to bring more yield-seeking capital into digital assets. The massive increase in potential collateral size is enormous. It really will allow to stabilize the asset as a whole and get rid of a lot of the concern around, can there be some core issues? The DAI savings rate creates a yield generating asset. So now, outside of pure speculation, you actually have a native yield and a risk-free rate. And then you can use that risk-free rate to start to really put prices on other risks. And this is how traditional fixed income instruments are priced. They're priced as a basis point spread to LIBOR or a 10-year or 30-year treasury. And we don't really have that today. The idea that the DAI savings rate, I think staking rates in other environments like ETH are going to play the same role of establishing a risk-free rate and then really setting a market around how does the market think about risk. And I think that's a really big and promising sign for the category as a whole. And so I think, how does this mechanically happen? We hit on a little bit, but just so that everybody gets it, the core carry trade strategy was developed around really borrowing Japanese yen and investing it in dollars or other high yielding instruments. You can do the same thing with digital assets, where you can borrow US dollars at 1.5%, buy DAI. There's carries to be had with the DSR above 2%. And if you're comfortable with lending on a fully collateralized basis, you might be able to get up to 5% in terms of carry that's effectively on a US dollar denominated asset. And when you saw this in like Japanese yen, US dollar type stuff, FX folks will use 100 times leverage or 300 times leverage because they're very comfortable with the risks involved here. And that pushes a ton of money into the space, expands the space dramatically, and closes that arbitrage, which is a healthy thing for the market overall. Okay, and so just in terms of on-ramps, I think a little shit on Stake does. We have a product for Dai and soon to be multi-collateral Dai that automatically allocates Dai to the highest yield at any time. So we call it robo-advisor for yield. It effectively performs this opportunity for you. So we look at things like Compound, DYDX, and Fulcrum, monitor yields for what's the highest yield, and automatically move assets via smart contract. So you keep custody of assets and it moves automatically to whatever yields the highest. And so we will be rolling the Dai savings rate into this, staking on ETH and liquidation opportunities as well. But this is how we see the space evolving and really starting to take advantage of some of these opportunities that are created through DSR. So that's basically it on us. If you want to keep up with us, we got some information here, and I will turn it back over to Robert.
Okay, thanks a lot, Tim. And now we'll hear.
Hi, this is Robert from Compound. Compound is a interest rate marketplace for Ethereum assets. Compound is currently the largest holder of single collateral Dai on the planet. We have over $20 million of Dai currently supplied to Compound, which winds up in the hands of two different types of individuals. One are people that are borrowing Dai, to say Psi from Compound. These are folks that are choosing between Maker and their ecosystem or sourcing Dai directly from Compound. And the other are those who are seeking yield. This is on Psi, as well as those who are looking to achieve a similar goal through the Dai savings rate right now. There's $25 million of Psi currently remaining in Compound, of which 13 is actively being borrowed by users. Today I wanted to talk through the migration process because this is probably the most exciting facet of Maker's launch, and we're extremely excited about the transition to multi-collateral Dai. So for context, what Compound does with an asset is we create a tokenized interest-bearing version of the asset. With Psi, we created an asset called C-Psi, which by holding C-Psi, you earn the interest rate applicable in that market. That interest rate for Psi is derived entirely from borrowers, those who are directly borrowing the Psi and paying an interest rate to the protocol. Now, our goal in this transition is for there to be two markets, and this is actually going to be really interesting. The first is our existing market, C-Psi. This is always going to exist as a market, including after the period in which Maker calls for a global settlement. The reason why this is interesting is that there's always going to be a residual interest rate on Psi and a residual opportunity to borrow Psi. And this plays out very favorably during the transition. The second is we're going to be creating a market for Dai called C-Dai. And we're planning to launch this soon. Now, the importance of having two markets during the transition is that it creates more of a two-way bridge. So in the Maker ecosystem today, you can directly convert Psi to Dai using the Psi as collateral to borrow Dai. You can directly migrate a CDP, assuming enough Psi has been migrated in the Maker system. And you can purchase Psi with Dai through Oasis. Now, one of the things that's interesting is that currently only the Compound Psi market exists. And so we're not able to help facilitate this transition at all. Right now, the Maker ecosystem is actually very dry when it comes to Psi. CDP owners are having difficulty migrating because Psi has migrated yet. Well, This is going to change when we launch the COO Dai marketplace. COO Dai is going to exist in parallel. In both assets, there's going to be an interest rate to borrow the asset and an interest rate that can be earned by supplying the asset. And the advantage of this is that it creates another backwards bridge between COO and Dai that's fully backwards compatible. So if you're a Maker user today and you would like to migrate from the COO ecosystem to the Dai ecosystem, you have two choices. If you're a COO holder, you're migrating really for the Dai savings rate, which exists on Dai, and it does not exist for COO. That makes sense. But you're also evaluating Compound as an opportunity cost. Right now, the yield on COO and Compound is a multiple of the Dai savings rate. It's currently about 2.5x larger. The second is if you're a CDP holder. Your decision to migrate is based solely on the borrowing costs of the system. Right now, CDP holders would like to migrate to Maker. Why? The stability fee is 1% cheaper. There's an economic incentive to migrate as a CDP holder. By creating both a CSI and a CDI market, we're actually going to provide a liquidity bridge that facilitates this and should make it significantly easier for both types of Maker users to transition. There's a couple of things we're going to do for the CDI market, which are relatively cool. This hasn't really been announced very publicly yet, but the most powerful thing we're going to do is we're going to create a new interest rate model for CDI in which the MKR token holders, by providing governance of the Maker ecosystem, by setting the Dai savings rate and the Dai stability fee, are actually going to be controlling the compound interest rate parameters. We're going to create interest rate parameters that simply shadow Makers. What's really cool about this is that Compound as a secondary market for Dai is going to be controlled entirely by the MKR token holders and community, which we're really excited about. Essentially, Compound is going to read from Maker. So if the Maker token holders decide to increase the Dai stability fee, you'll see the interest rate model in Compound adapt. If you see them change the Dai stability fee, you'll see the interest rate parameters in Compound adapt as well. And this is a way of actually reinforcing the governance that MKR token holders currently have on the Dai system. We want there to be a single unified interest rate model such that Compound's interest rates can react and form a much more symbiotic relationship with Maker. I think this is a really cool way of increasing the power of MKR token. Now, I touched on this briefly before, but there's a couple of things that influence the migration. The first are interest rate differentials on supply. Currently, there is no compound yield on Dai because the market doesn't exist yet. But when this market is created, there's going to be differences between the compound Dai interest rate and the Maker Dai savings rate. The second are interest rate differentials on borrowing. There's going to be a differential between the compound borrowing interest rate, even though it's going to be controlled directly by the MKR token holders, and the stability fee on Maker. And this is because of utilization. So what we're going to be doing is targeting the equilibrium interest rate on Compound to equal that on Maker. When usage of Compound is low, the interest rate to borrow on Compound will be lower than Maker. When the utilization on Compound is high, the interest rate to use Compound will be higher than on Maker. And in this way, there's always going to be some spread, positive or negative, to borrow Dai from Maker or from Compound. Lastly, there's differences in collateralization and collateral types. Currently, Maker supports Ether and Basic Attention Token as the two collateral types to create Dai through the Maker platform, whereas Compound offers different collateral types at different collateralization requirements. It's hard to model exactly what type of impact this will play in the migration, but we definitely think that it's an interesting set of parameters to keep your eye on. Now, lastly, I'd like to walk you through the current status of the markets as of this morning. There's currently 24.54 million Psi supplied to Compound, yielding 5.66%. There's currently 12.94 million Psi being borrowed from Compound at an interest rate of 11.3%. The Dai marketplace does not yet exist on Compound. On Maker, there's a total of 13.5 million Dai that has been created, of which approximately 1 million has been supplied to the Dai savings. There's currently no Psi in the Maker bridge as it currently stands. And so CDP holders are having a difficult time migrating their debt from Psi to Dai. As Compound launches a Dai market over the next couple of days, it's going to be very interesting to watch these numbers and dynamics. You can track both of these live in real time on compound.finance/markets and daistats.com. In closing, we're so far very excited by the transition process. The community of Maker and Compound has so far seen a very smooth transition, but it's also been very early in the process. Going forward, I think the thing to expect is the unexpected. Interest rates may be particularly volatile in Maker, Compound, or both. We're starting to see significant chatter from the Maker community about reacting to the first couple of days of the migration. And we're starting to see communication in the Compound community about the migration. It's hard to anticipate exactly what users in either community are going to do, how they're going to behave, or how they're going to migrate. And as with all things, it's very hard to predict what happens. There might be significant shocks to either system. So please be careful as you use either system during this migration period. And we're also seeing a significant series of applications begin to discuss the migration. Some applications have to wait for Compound to launch Dai. Some are able to migrate directly themselves. You know, an application like Staked has to take into account, you know, the Dai market on Compound and on Maker and on other secondary platforms. And so it's going to be very interesting to watch when and how applications migrate. It might be weeks before we start to see a wholesale transition. In conclusion, we're extremely excited about MakerDAO and this transition from Psi to multi-collateral Dai. It's going to bring significant benefits to users, whether they're debt holders or asset holders. And we think this is going to be a key moment for the ecosystem to evolve in new and unexpected ways. Thank you.
Okay, that was terrific, Robert. Thank you. So we're now going to open it up to questions that we'll pick from the audience. We've got 4 questions. If you want to put in an additional question, feel free to do so. Again, there'll be a tab. And also, I've been asked a couple times, so just want everybody to be aware that this call is being recorded and a replay will be available tomorrow via my Medium page. Again, I'm Luke Kerner, and on Crypto Oracle's YouTube page, and everybody who RSVP'd to the call will get a link, will get an email with a link to the replay as well. And before we go to questions from the audience, you know, I just want to start with one for Steven. You know, the introduction of now multi-collateral Dai and adding BAT, which, you know, Robert just showed is around 2%. You know, first, was that, you know, is that kind of in line with whatever expectations Maker had? And then as you think about, you know, adding new collateral, you know, that'll be accepted as collateral, and obviously this is going to be governed by the community. But, you know, how do you see that happening, you know, unfolding, you know, over the coming months and into, you know, into 2020? You know, do you think in a year, you know, we're going to have 5 or 50 or 5,000 different collateral types on the multi-collateral Dai? Steven?
Yeah, I would definitely like to answer that question by saying like 50,000. It'll be awesome. But that's just wishful thinking. But what I can say is that the depth of conversation around collateral types and also the type of assets underlying those collateral types has definitely been quite broad and deep. So from my data points, and just keep in mind that this is really something that's up to MKR governance, from my point of view, my data point, I'd say that we can see discussions around another 3-4 crypto assets and even establish a lot of conversation around centralized stablecoins as well as potential collateral types as well, which really brings up a whole bunch of interesting conversations that Allison touched on with respect to recourse into the analog world and what does that look like. But I feel that those are the discussions we need to have in order to engage and expand this DeFi space.
Okay, that all makes sense. And also, before I start asking some of the questions from the audience, I want to give the opportunity to the other speakers as well. It was funny, before we went live, people were asking, Steven questions as well. So I want to give everybody, the Allison, Tim, Robert, if you've got a question as well, I'm sure whatever you're thinking would be a great question for the audience as well.
Before you do that, I would like to actually say thank you to Allison, Tim, and Robert for putting in so much thought and being very articulate and very considered about multi-collateral Dai and how they see it. I really do appreciate the amount of effort that they put in.
Yeah, agreed. So I don't know, Allison, Tim, Robert, any of you have anything that you'd like to ask Steven? Going once.
Yeah, one quick question, Steven. And by the way, we're extremely excited about this transition process. Do you see the primary levers in this migration as being, focused on changing the parameters of Psi or changing the parameters of Dai? I've seen in the chat rooms and forums that this is sort of an evolving conversation. But do you really, see either one of them as being more important in terms of the economic parameters, or do you see them having to be controlled?
Maker governance needs to have both in mind at the same time. It really needs to consider, from a temporal aspect, where we are with respect to the migration, and then effectively implement, at least from a conversational point of view, which levers they want to move. So you've got the stability fee on the Psi side that you can obviously change in relation to the stability fee on the Dai side. So that's obviously one parameter that needs to be looked at. The larger the spread there, the more you have economic incentive to move across. Likewise with the DSR. Obviously, if the DSR has a sufficiently nominally high value, then you've got another incentive factor. So you've got three variables to look at. So you've got permutations there that MKR governance needs to consider very clearly, but they need to consider it, as I said, from a temporal aspect. Like right now, as Robert showed, there's about 13.5 million Dai that's been created in the new system. A very important component to consider is, well, how much of that is newly minted and how much of that is migrated? And that consideration needs to inform what the next steps MKR governance should take.
Cool. Thanks for that. Allison or Robert?
Yeah, actually, I had a question for Steven about the role of the interim risk team. Could you talk a bit about the role of the interim risk team under Psi and how it changes or evolves under Dai, as well as kind of the process forthcoming for how risk teams, the process for becoming a risk team under Dai?
First aspect to keep in mind is that from the Maker Foundation point of view, the teams and the applications we put in place are really templates. So the interim risk team is a template, and we're expressing to the Maker community at large that this is the consideration that you need to have in order to become a risk team. And importantly, from Psi to Dai, that concept doesn't change. But what does change is the fact that when new collateral types are considered, when new conversations around parameter permutations and economics are considered, it does need an expansion of talent, it needs an expansion of skill, and that is really where the hope is that this interim risk team starts, well, firstly is the template and starts being used by other folks to create their risk teams. Now, they don't necessarily have to use the same template. They can come up with their own. They can focus on certain granular aspects. For instance, you might find that a risk team is more more biased towards economics and is interested in the effect of the interest rate sensitivities on the system. Further to that, you can have risk teams that focus on specific collateral types. So ultimately, what the interim risk team is the kernel of what I like to call the decentralized risk function, or rather the ecosystem built around it in order to support the collateral types and considerations that folks need to have about the protocol. So from start to finish, interim risk team, template, the final idea, decentralized risk function with full granularity, looking after a spectrum of things to consider from collateral all the way through to economic modeling.
Thanks.
Cool. And Robert, last chance. Once, twice. Okay, cool. So first, yeah, Robert.
So in the Maker governance polling, you know, the stability fee for Sai was just cut down to 4%. Do you see this being beneficial for the migration, and how?
I think that there are a couple of possibilities that would make it beneficial. I mean, obviously, a better approach would to create call it a so-called deterrent on the Sai side to incentivize folks coming across. So an increase in the stability fee might be more effective. But at the same time, it really comes down to what Maker governance considers to be the right thing to do at that point in time. My data point is, well, if migration has paused, or if migration is has been blocked for some reason, it may behoove Maker governance to consider increasing the DSR and increasing the size stability fee to get the economic incentives in place. But again, this is my data point where really what needs to be done is the conversation brought from the community into a governance proposal that really looks at that. So I think right now there's a lot of positions with respect to what the levers should be to make the migration work better. And I'm of the opinion that you need to take that point of view in terms of where the migration currently is. And where it is right now, I think, and knock on wood, is quite successful. So I suppose it goes to the simple adage that, you know, if it's ain't broken, you don't need to fix it. So that's where I am at the moment on that.
Cool. Thanks for that, Steven. I'll take the first question. I think is for Tim, but it'd also be great if anybody else, any of the other speakers have thoughts that they'd like to add as well. And that's, you know, the question is, you know, will the extra income from using Ray versus using something like, you know, Compound be enough to make up for the additional smart contract risk?
Yeah. So
how do you think about that? Yeah.
I think the answer is going to be different for different people, right? And that's a decision every individual needs to make. I think Ray today looks like an arbitrage between a number of lending opportunities, because that's where it started. The ultimate incarnation of that product probably looks fairly different from where it is today, as it starts to take into account other things that pooled liquidity can take advantage of. And that includes things like staking, the DSR, but it also includes things like handling liquidations and other forms of kind of risk-free or risk-minimized yield opportunities that expand the set of things that you can do here. So I think, you know, the answer is always going to change, and the question is, what's the extra yield that's being delivered versus your risk that comes from working with something like Ray?
Okay, thanks, Tim. Any of the other speakers want to add anything to that?
I just want to point out really how cool that example is that you know, Tim showed, and it really, if you have a look, my past life, I was also in traditional finance, so I'm used to, you know, what Allison said with respect to rolling futures forward, you know, understanding. I did interest rate derivative trading, so what Tim said really resonates with me, and that carry example that he showed was exceptionally important, because if you deconstruct the risk of it, at the heart of it, you've effectively got that centralized intersection with decentralized finance. And the arbitrage there is, to a certain extent, taking in consideration that risk of the decentralized component, which is still being priced. And the discovery around that is really essential. And that will give the analog world the opportunity to understand how to price risk appropriately in the decentralized world and start moving more of the operations and businesses on chain.
Interesting. Cole, I know that you had a question, so do you want to ask yourself, or I can ask it?
Maybe I don't think I meant to do. I don't have a question. I might have been a fat finger.
Okay. Steven, when you were talking about real world assets, are there real world assets that you think are kind of lower hanging fruit that you think would be easier to have part of multi-collateral Dai?
At the moment, we can basically look at what Allison's producing from their point of view. I think that's pretty much the first sort of low-hanging fruit when you looked at the sort of wrapped assets that are getting digital representation on the blockchain. You can start with that, but essentially what you need to consider when you step back, you need to think, well, who wants to tokenize real-world assets first? And when you look around the sort of financial spectrum and identify these folks, it generally always comes back to supply chain finance. The risk-adjusted rate of return in supply chain finance is absolutely massive, to the point that there is so much arbitrage opportunity there if you just simply bring it on chain. So from my perspective, tokenizing the necessary invoices within the supply chain finance infrastructure will start showcasing very clearly the dovetail effect between the analog world and the on-chain world to realize not only better financing, more versatile financing, but really great opportunities as well. Okay, good, makes sense. Last question I think that we have time for from the audience is for DSR, why did you decide to not tokenize it, making it transfer ERC20? That is really about primitives. That's really about saying, well, how do you go about effecting a stabilization mechanism for the protocol as a whole? And where the stability fee helps with supply, the DSR helps with demand. It's really that simple. But in terms of wrapping Dai in DSR, well, that is something that we definitely as a community, and I think there's quite a lot of conversation about it, has really started. And I would really anticipate Baker governance looking at creating something like that going forward. So, keep an eye out for that. I definitely think that's on the horizon.
Okay. I think we might have time just for one more. I thought it was an interesting question. Is MakerDAO or any known entity marketing to communities experiencing severe inflation, like Mariano has referenced in Argentina with DSR? So that's obviously a market that folks are interested in. Just would love to get anybody's thoughts.
Shall I start?
Sure.
Okay, so here's the interesting thing. It's not so much marketing, it's that we hear from a lot of the emerging markets why they consider, firstly, the blockchain space to be certainly important for them. Firstly, with respect to Bitcoin, then with respect to other stable coins out there that they've started to use. And from that point of view, launching multi-collateral Dai really opens up the full extent, the full potential of this protocol. In single collateral Dai, you really had only one of the two tenets of the economic engine working full steam, and that was credit generation, where collateralization was limited to Ether. And now, when you've got the ability to provide multiple collateral types, you really can open up that full economic engine. So in emerging markets, you can create the infrastructure that can be the backbone for creating stable stores of value. So when you think about Argentina, Venezuela, Chile, we've gotten interest from Central Africa, certain parts of Northern Africa, all the way also to certain parts of the APAC region as well. There is a lot of interest in using not just DAI as a stable coin, but using the protocol as an engine to underlie the growth and development of the economies in these particular countries. I'm going to stop there, but I could go on. That one's a big conversation we can have.
Yeah, no, that's really amazing. I just did any of the other speakers want to add anything to that? Going once, twice. Okay, look, we've already gone a little past, but I'd really like to thank Steven, Allison, Tim, and Robert for a terrific call. Thanks, everybody.
Thank you very much for having me. Really
Thanks for having us. This was great.
Thank you. Congrats on MCD.
Thank you very much.
Okay. Bye, everybody.
Bye-bye.